Welcome to the Vulcan Way Academy. This is our introductory course on building long-term wealth. Today, we'll explore key strategies for financial success. Did you know that 63% of Americans can't afford a $500 emergency? Financial education is lacking in schools, and many parents struggle to teach money management. Talking about money is often taboo. How can we change this? By teaching each other and learning how to do better financially. Building wealth is simpler than you might think. Basic financial education can make a big difference. You can turn $100 into $1,000, then $10,000, and beyond. Interestingly, 80% of millionaires come from middle-income or lower-income families. Let's start with budgeting. Track your expenses using apps or spreadsheets for 60 days. Popular apps include Rocket Money, YNAB, EveryDollar, and Monarch Money. Identify unnecessary spending and impulse purchases. Look for areas to negotiate or reduce costs. This can save you 10 to 15% just by tracking and optimizing. Next, optimize your cash. High-yield savings accounts offer 4 to 5% interest. Examples include Ally Bank, Wealthfront, and Robinhood Gold. Treasury money market funds pay over 5%. Keep about 20% of your portfolio in cash equivalents. The average American owes $22,000 in credit cards, car loans, and more. High interest rates can cost thousands per year. Pay off debt with higher interest than your investments earn. Use the avalanche or snowball method to tackle this debt. The avalanche method focuses on paying off debt by targeting the highest interest rates first. Make minimum payments on all debts, pay extra on the highest interest debt, and roll over payments as debts are paid off. Be patient and consistent for the best results. The debt snowball method helps you pay off multiple debts by starting with the smallest balance. List your debts, make minimum payments, and put extra money toward the smallest debt. Once it's paid off, move to the next smallest debt. This method builds momentum and a sense of accomplishment. Consider opening a Roth IRA. You can contribute up to $7,000 per year, and earnings grow tax-free. You can withdraw contributions anytime without penalty. It's available if you make under $161,000 per year as a single filer. Compound interest is a powerful tool. For example, maxing out a Roth IRA from age 20 to 65 with an 8% average return can result in $3,145,000 at retirement. The rule of 72 helps you calculate how long it takes for your money to double. Divide 72 by the interest rate to find the number of years needed. Dollar cost averaging involves investing a fixed amount regularly, regardless of market conditions. This strategy helps reduce the impact of market volatility and removes emotion from investing decisions. How might this strategy benefit you over time? Asset allocation involves dividing investments among different asset classes like stocks, bonds, and cash. It depends on your risk tolerance and time horizon. How would you allocate your investments at your current age, and how might this change as you get older? Bonds can provide steady income and reduce portfolio volatility. They are generally less risky than stocks but offer lower potential returns. Types include government, municipal, and corporate bonds. How do interest rates affect bond prices? REITs allow you to invest in real estate without buying property. They provide exposure to commercial real estate markets and often offer higher dividend yields than stocks. What are the potential advantages of REITs over direct property ownership? Investing in foreign markets can reduce overall portfolio risk and provide exposure to faster-growing economies. It can help offset poor performance in domestic markets. How much of your portfolio would you allocate to international stocks? Investment fees can significantly impact long-term returns. Common fees include expense ratios, transaction costs, and advisory fees. Low-cost index funds typically have lower fees than actively managed funds. How might a 1% difference in fees affect your returns over 30 years? Dividends can provide steady income or be reinvested for growth. Dividend-paying stocks are often less volatile than growth stocks. Reinvesting dividends can significantly boost long-term returns. What are the potential drawbacks of focusing solely on dividend stocks? Rebalancing your portfolio involves periodically adjusting your investments to maintain the desired asset allocation. It helps manage risk and can improve returns. Why is rebalancing important for long-term investors? Emotions can lead to poor investment decisions. Common biases include loss aversion, recency bias, and herd mentality. Developing a disciplined approach can improve results. How can you overcome these psychological challenges? Diversify to spread risk. Avoid putting all your money in one stock or cryptocurrency. Don't try to beat the market, most professionals can't. Consider index funds for broad market exposure. Index funds are investment funds that follow a benchmark index, such as the S&P 500 or the NASDAQ 100. When you put money into an index fund, that cash is then used to invest in all the companies that make up the particular index, which gives you a more diverse portfolio than if you were buying individual stocks. They offer a wide variety of stocks and industries, are highly diversified, low cost to own, and some have no fees. Warren Buffett recommends them for most people. Why do you think index funds are popular? The S&P 500 has an average annual return of 10.6% over the past 100 years, and 13.4% over the last 14 years. However, past performance doesn't guarantee future results. Returns depend on when you start and how long you invest. Factors that could affect future stock market returns include interest rates, inflation, economic growth, market sentiment, and more. Essentially, any factor that impacts the overall economic landscape and investor psychology can influence stock market performance. Inflation erodes purchasing power over time. Historically, the average inflation rate is 3% per year. This means that $100 today may only buy $74 worth of goods in 10 years. How does inflation affect your long-term financial goals? What strategies can you use to outpace inflation? Vanguard predicts a 4.2 to 6.2% annual return over the next 10 years, while Charles Schwab predicts a 6.2% annual return for large company stocks. Returns of 12 to 15% annually are not normal or sustainable. A long-term average of 7 to 8% is more likely. There are several index fund strategies to consider. A simple 2-fund approach, a 4-fund strategy, the Vulcan way strategy, regular buying regardless of price, long-term hold for 20 to 30 years, and the set it and forget it method. Consider keeping 20% in cash equivalents earning 5.2 to 5.3%, which provides liquidity for expenses and opportunities. Allocate 10% in alternatives like Bitcoin, and have a fund category with no expectations. How might this approach balance risk and opportunity? To build wealth, optimize income and expenses, pay down high-interest debt, maximize tax-advantaged accounts, diversify investments, and stay consistent long-term. Which principle do you think is most challenging? Building wealth takes time. Avoid get-rich-quick schemes, focus on a strong financial foundation, use timeless strategies, and stay motivated for long-term investing. How can you stay motivated for long-term investing? Track your expenses for 60 days, open a high-yield savings account, create a debt repayment plan, research Roth IRAs and index funds, and set financial goals for the next 5 years. What's your first step towards financial success? Financial success is achievable for everyone. Start small and be consistent, learn from reliable sources, and don't be afraid to ask questions. Your future self will thank you. What's one thing you learned today that you'll apply to your finances?